Hey guys, it's Paul here. Semiconductors had and still have a promising future ahead. That's why in today's video I'd like to make a little stock comparison on advanced micro devices, Nvidia and Intel. I hesitated a lot doing this type of content because just researching numbers and reading them out to you is a little boring to me. But I've had quite some time at home recently, so I taught myself a bit about web development and wrote a tool to compare stocks. It can't do much yet, but it is already capable of plotting the stock price and some fundamentals. It also calculates a few financial indicators to contextualize the companies in its sectors. You will see how it looks like in a few minutes. So, I chose these three companies because I think that many people consider investing in them at the moment, as not only the companies but as well their underlying sector, the semiconductors, is pretty promising. All three companies are large capitalized and established already. Moreover, they are located in the USA. AMD develops computer processors for both business and consumer markets. Their products range from motherboard chipsets, CPUs, APUs, over to GPUs, server processors, and more. In 2014, Lisa Su was appointed CEO, and looking at how the company has developed since then, this was a pretty good idea. This year, they announced to take over Xilinx, which shall help them grow especially their data center segment. Furthermore, they are able to produce CPUs containing 7 nanometers transistors, of which their competitor Intel is not capable yet. While strictly speaking, TSMC, Taiwan Semiconductors, is capable of that, which is the company producing for AMD. Because AMD produces fabless, which means without own production plants. Intel is pretty much operating in the same segments as AMD, but with a higher weighting to CPUs. An important difference between these two companies is that Intel produces on its own production plants. This was considered an advantage for a long time, since Intel was pretty independent like this, but like I already mentioned, it backfired lately, as Intel did not manage to upgrade their plants to a 7 nanometers production. What Intel is partially able to do though since 2018 is 10 nanometers technology on some products. But here as well, they still have some problems. Let's clarify this nanometers thing real quick. A CPU, a central processing unit, consists of billions of tiny transistors that switch on and off to perform calculations. To do these, it takes power, and the smaller they are, the less power is required. So, since smaller transistors are more power efficient, they can do more calculations without getting too hot, which usually is the limiting factor for CPU performance. Also, the density of transistors can be increased, making the CPU smaller or just containing more of them. Now, there is not directly a linear correlation between the transistor size and performance, meaning that a 7 nanometer transistor CPU is not necessarily twice as fast as a 14 nanometer transistor CPU. As far as I know, for example, AMD's 7 nanometers node is not decisively faster than Intel's 10 nanometers. The technology used to produce these transistors is called photolithography, by the way. Another interesting thing about the lesser nanometers is that the battery life of smartphones can be increased as the newer technology needs less power. Still, Intel is not being able to produce effectively on 7 nanometers is going to cost them a huge amount of money besides falling behind their competitors. Last but not least, Nvidia. They are mainly known for their graphic processing units and pretty much dominating the market here. This September, they announced to take over ARM for $40 billion from SoftBank, which they again acquired in only 2016 for around $33.5 billion. ARM is mainly involved in industrial automation, autonomic driving and data centers. All fields that Nvidia is either highly involved already or planning on expanding to. A big revenue driver of Nvidia in the last few years especially were cryptocurrency miners. According to Barron's, they sold $175 million worth of GeForce RTX 3000 to Ethereum miners only. Now I'm talking hours and haven't shown you a single graph yet. And neither did I tell you to like this video and subscribe to my channel. How bad am I? So here you can see my tool in action. I've opened all three companies next to each other, and what directly catches my view is that despite being the most specialized company of all three, Nvidia has the biggest market capitalization. By far. About their respective products we have already talked, so let's skip that and scroll down a little to the price charts. The charts show candlesticks for the last 5 years, and you can see that if you invested in AMD, you were up 51-fold, in Nvidia, you were up 22-fold, and in Intel, you made at least 61%. Insane returns. Nvidia and AMD make Intel look like kindergarten in these charts, which is only partwise true. I mean, Intel paid a dividend of around 2.5% additional, what left investors with a 10% gain annualized. Which is still a good return and more what most investors can say about their own portfolios in the long run. And regarding these three companies, I'd consider Intel more of a conservative investment, like so it at least fulfilled its investment case. AMD and Nvidia were and still are growth stocks. So let's take a closer look on the fundamentals and see if the stock prices are somehow justified there. And yes, an increasing stock price in the last 5 years could definitely come from increasing both revenues and earnings dramatically. AMD made around $4 billion revenue in 2015 and increased that up to 6.7 in 2019. And I can tell you, they are still on this growth course right now, which you will see in the quarterly chart in a minute. So not only did they increase their revenue, they also managed to increase their margins. Regarding the net margin, it went up from -16.5% to a little more than 5%, finally enabling AMD to write black figures in their cash flow statements. Lisa seems to have done a great job there since her appointment in 2014. For both Nvidia and Intel, it's pretty much the same thing. Intel increased its revenue for around 30% and Nvidia for a stunning 134%. Unlike AMD, both companies managed to be profitable for the whole time frame and even to pay a dividend, as you can see here, at a moderate payout ratio. What I also like is that they as well managed to increase their revenues simultaneously to their margins, accelerating earnings growth even more. Especially at Nvidia, you can see this effect perfectly. They approximately doubled revenue and net margin, resulting in a more than quadrupling earnings. Exactly what you want to see happening to the companies you're invested in. Looks pretty good so far, but do 4-fold earnings justify a 22-fold stock price? Only as long as the growth continues. And how can earnings growth continue? Either by selling more chips, selling more expensive chips, or increasing the margins. And just from looking at the charts, I'd say that margins of Intel should in the long run stay the same. They are well established, most processes are optimized, and they have some cost ahead when it comes to upgrade their production plants. Nvidia's margins are pretty high already, but they might increase their volume and sales looking at the acquisition of ARMs and the relevance of data centers in the future. Intel is operating in that segment as well, of course, but I think that at the moment they are losing market shares. AMD's margins are the lowest, implicating a scope to the upside, and they are already producing 7nm chips at TSMC, of which Intel is not capable yet. Looking pretty good in my opinion, whereby you need to take into consideration as well that AMD's valuation is already way higher than Intel's, meaning that some of that advance might already be priced in. Looking at the quarterly numbers, you can identify what I already said. AMD and Nvidia seem to keep up their momentum, and Intel stagnates a little. But that's it, they remain on the same level and do not go bankrupt, which seems to be something many investors believe. Sadly, I do not have data on analysts' forecasts yet, but it's definitely on my agenda. Now the next chart I've got for you guys is pretty interesting in my opinion. It shows the outstanding number of shares combined with the impact of buybacks and newly diluted shares on the earnings per share. What definitely catches the view is that AMD is permanently emitting new shares, which has a slightly negative effect. Intel, on the other hand, bought back shares constantly over the last 10 years, which led to an improvement of the EPS. Especially from 2018 to 2019, you can see that an increase in earnings per share was only made possible by a reduction of outstanding shares. Nvidia's outstanding shares have no explicit direction. What has a concrete direction is the value of Nvidia's assets, I'd say. The next graph is meant to show assets and debts of the respective company as well as the debt ratio. Unfortunately, my code isn't perfect yet, that's why sometimes individual numbers are still missing. In this case, it's the total liabilities with the consequence of the debt ratio missing as well. So nevertheless, you can see the assets value being up 4-fold, including almost $11 billion in cash and short-term liabilities, and almost $10 billion in treasury stocks. This explains part-wise how they want to afford taking over ARM. Intel's assets only doubled in value, including around $13 billion cash and as well around $26 billion goodwill. Simply put, goodwill is an immaterial asset, mostly not of physical value, that has to be taken over or bought too. It can contain things such as the quality of management, customers, or even image and know-how. I usually don't like a high amount of goodwill on balance sheets, as its calculation is pretty much depending on the point of view you have. Nevertheless, it is striking that Intel's market capitalization equals only twice its assets, while the other two companies have a lot higher multiples. Last but not least, AMD managed to decrease its debt ratio from around 110% to about 53%. In the same time, they increased their cash balance to a little more than $1.5 billion. Both could be partly due to the emission of new shares. That's it with the graphs. Tell me if you'd like to see more data or even other data so that I can implement them if possible. I'm pretty much open for any feedback that makes this tool more helpful. But it's not over yet. After these beautiful charts, I also made some calculations for each company, including a variety of financial figures that come together in different scoring systems, starting with the Piotrowski F-score. And it's simple. It concludes 9 different conditions. If one is fulfilled, the score receives a point. The maximum amount of points achievable are 9. It would burst the time frame of this video explaining the meaning of each of them, but I guess just from reading you might understand what they are about. Whereas this score is mainly to evaluate the year-on-year performance of a company, the next score upcoming is evaluating a longer time frame of up to 10 years. Retrospective, 3 to 5 years would have been enough, since in 10 years just too many stuff happens. The entire business model could have changed. Anyways, this score works pretty much the same as the Piotrowski score, but with other figures. I don't know yet why exactly my app thinks that AMD bought back shares over the last 5 years, but I'm going to find out and fix it. Ridiculous. Every time I think I've finished something, I find out a week later that I still messed up. What strikes the eye at this score is that AMD scores pretty bad compared to the others. And this is especially due to the score depending a lot on earnings proportional to other figures, like the debt for example. In the debt to assets chart, AMD looked pretty well, but if you compare their debt to their EBIT, it's in an unhealthy relation. It would take them over 6 years from now to pay off all their debt, subject to the condition of course that they wouldn't increase their EBIT in that time frame. The last score I have is pretty much the quality score, but set in context to all the other companies out of their respective sector. It takes a look at the individual figure, and if it scores better than 66% of their competitors, it receives a point. This thing puts a smile on my face every time I see it. It takes just a few seconds to see how well a company performs compared to their competitors. It is not working perfectly yet, as you can see at the 10 years dividend growth, but I'm gonna fix it soon. Also, something's wrong with the PE ratio obviously, because never ever is Intel value too high to not receive a point here. What's still missing to me here are forecasts and shorter time frames as well. But as soon as this is implemented, I can't wait to check the companies of my portfolio here and see if I made the right investments or not. If you wonder what KUV is, it's the German abbreviation for price to revenue ratio. If you have any suggestions at this point again on which figures I missed out at this place, don't hesitate to tell me in the comments. I hope that all the material I presented to you in this video helps you make your decision. Anyways, thank you for tuning in and hopefully see you in another video. Stay rational.